Okay, I know you've seen the title. What if I told you there was an ETF out there where you can make money whether the stock market goes up or you can make money if the stock market goes down? Now, it sounds good to be true, but this product is pretty legit. Of course, it's not perfect, but anytime you can make money when the market goes up, make money when the market goes down, it's not like you have to spend any time or energy. You would just end up purchasing the ETF and then you would be good to go. Now, I'm excited to end up telling you more about the ETF. It's called a dual directional ETF, where basically it allows you to just enter the position in the overall stock market and be able to make money if the market goes up, make money if the market goes down, and also offer you downside protection. Now, of course, you have to watch the whole video to see how everything works and to know the small details, which is important. But before we get started, make sure you smash the like button because it helps the YouTube algorithm. It helps YouTube know that this is quality content and help my video reach a broader audience. So, like I said, this to me is major, especially for people who are more cautious investors or they are looking to get higher rich. They don't want the full on risk of just investing 100% stocks, but it'll definitely give you a better yield than high yield savings, bonds, and it can get still allow you to get those double digit returns without all that short term volatility. I myself, I thought it was so impressive that I ended up purchasing some shares for myself. Now, let's jump into it. Okay, and I'll try to make my screen bigger so you guys can see it. The name of these ETFs, and by the way, if you're not sure what an ETF is, it's a basket of stocks where you can end up buying on the stock exchange. Now this one is a lot more going on behind the scenes, but don't worry, I'll explain it. So they're called dual directional ETFs. Now they normally have one for every single month, and the way that this works is it's an outcome period. So the outcome period can vary, but for this particular ETF, what they end up doing is they end up tracking SPY, which versus the largest 500 companies, the S&P, and that's what the benchmark that this ETF is tracking. Now, most of the time, the period for these is over a year's time. Um, and keep in mind, I have another one, and by the way, the ticker for this one is DDTS. Um, the last one each month they'll have like for S for September, so November would be N, December would be D, but it's the same structure. Now, keep in mind too, I'm trying to make sure I can make this as uh, big as possible so you guys can see it pretty. Maybe that might be a little too big, but it should be good enough. So let me move this one. So basically, this is how it ended up working. Um, they have buffer. Now, if you by the way, if I also did a video on buffer ETFs, which is a downside protection. If you want to see a more in-depth video, just check the suggested videos. Okay, so let me make it a little bit smaller, and let's just read quickly the summary so you guys can. It says the equity. The innovative equity dual directional 10% buffer is designed to pursue positive returns in both rising markets and certain declining markets before fees and expenses. By capitalizing gains by capturing gains to a cap where the reference asset increases, delivering positive returns when the reference asset falls within a inverse performance threshold and limiting losses beyond the threshold. This ETF can be held indefinitely, resetting at the end of each period. So the index is tracking is the S&P 500, which everybody's familiar with. Now, if you see the 10%, now this particular ETF, if you would have bought it at the beginning September 1st, first 10% if the S&P goes down within 10%, you would not lose any money. So that's where the buffer is. So that part should be pretty simple. Um, Up into the first 10%, you lose no money. Actually, you would gain money, but as long as it's less than 10%. But keep it let's keep it simple first. Let's start from the outcome period cap. So basically, what this ETF is, the highest returns, and keep in mind this is over a year's time. So in order for this um, to get the buffer, you would have to hold it within that whole year's time. So the upside period cap is 12.65%. So within a year, if the S&P goes anywhere above that 12.65%, you would just only get a 12.65% return. That would be the cap that you would get. You always have the ability to sell midway if you want, but the highest that you would be able returns that you would be able to get is 12.65%. So if the S&P did 20, you would still get 12.65% because that's the cap. Why would you might do that? I'll explain. So in return, uh, this ETF is offering a buffer of 10%. So that means if the S&P drops down 10%, then you actually break even. If the S&P drops 15%, you're only down 5%. But check this out. The third layer is the outcome period inverse cap. Now this part is new to it. So this outcome period inverse cap ETF basically saying as long as the S&P does not go below 10%, you actually still make money. So if the S&P drops 7%, you are actually up 7%. If the S&P drops 9%, you're actually up 9%. Now the inverse has a cap. Now if the S&P drops, let's say 12%, then you're actually down 2%. So that's when the buffer kicks into play. So the way that they can do this, I end up jotting down some notes. They do deep in the call money. They buy and sell puts, which allows you to make money. Put spreads. They buy and sell put spreads, what allows you to make money when the market is down. And they sell out of the call monies to end up doing the downside protection. Alright, so here's a chart that basically explains it's aimed to make money 95% of the time. And I'll explain the chart. So basically, look at the 30, 20, 10, 0, 10, 20, 30. These are like the returns of when you would actually make money. Now, in this example, with the buffer, this has to be a buffer 10. So basically, you would make money whether the S&P loses 10% money in 95% of the situations. Is the S&P lose 10%, 0%, 10%, 20%, 30%, you will always make money. And here's the thing, you will only start to lose money after there's a 15 percent loss. Even if the S&P loses 10%, you still end up making money. Now, if it goes, like I said, if it goes lower than 10%, let's say if it went to 15, you would lose money, but you would only be down 5% versus everybody else would be down 15. So I hope that explains it. Just look at, once again, these are kind of like what the returns, what the returns would be, and if you would make money. So this is basically where you can see where you would end up starting to lose money. There, the outcome period. You always want to be able to get these caps. You always want to get it the day of that the fund was released. So it says 365 days, because if you don't, then you have to pay attention to the remaining buffer and the downside before buffer. So since it's midway before the buffer kicks in, It would have to go. I think one is before with fees and one is after fees. So after fees, it would have to go down 2.56% before the buffer actually kicks in. And you also would want to know the remaining cap on the buffer and the inverse cap. So if you buy it midway, it becomes a lot more moving pieces. But if you buy it from the initial day, always set a limit order so that just in case, just always set a limit order for something like this. So therefore, you would know your cap will be 12.65, buffers 10. Um, the side on the left is before fees. The side on the right is after fees. So I'm just going to make it clean. I'm just going to explain it before fees. But keep in mind, if you wanted to know what it would be after fees, you would just end up looking at the other number. So the 12.65%, that's the cap. Inverse cap, 10%. So that basically means you make money as long as the S&P doesn't drop more than 10%. If the S&P drop more than 10%, that's when you'll start losing money. Um, the buffer, 10% protection. So um, you only start losing money after you first start losing money once the S&P drops down past 10%. Downside before buffer. Now, of course, if you buy it on the first day, there's no downside buffer in its outcome. In order for you to end up getting it, you have to hold it, throughout the whole 365 day period. So you have to hold it throughout that whole time frame. Options. So if you wanted, like I said, I can drop this down and below. It shows exactly more details about the inner workings of the fund. I'll go over it quickly just in case you guys, what like to, and I'll also give you another example as well so you can see the difference between the funds. But layer one, it says the first layer involves buying deep in the money call options on the reference asset. Most of the time it's the S&P, but they have ones you can track other ones, providing long exposure to reference assets. So first thing, deep in the call money. Second layer. The second layer is a put spread. The combined effect of purchasing and selling two contracts aim to produce gains when the market declines with the 15% downside protection. The third step, and you can also look at the picture. The third step, the third layer helps funds to sort after downside protection while transition to a buffer profile and deeper draw side. So they have and they end up showing you exactly sell 15 puts, purchase 15 put options. And the fourth layer consists of selling a call. The call is sold as far out of the money as possible while generating enough to cover the the cost of the buffer. The sale of this call is what creates the upside potential. So, like I said, it has a lot of moving pieces. The expense ratio is 0.79, which is not bad given all that is going on in this particular fund. Now let me click on dual directional ETFs. They also have a whole bunch of other ones, but this video is just focusing on. So as you can see, for September they have two, one for 10 and one for 15, and I'll explain to you. And by the way, they also have one for July. So these literally funds just came out. That's why if you watch my channel, I'll put you on with different types of investments. That's what I'm doing. Like as far as looking at different type of investments, opportunity, different plays. Now to me, this is kind of more so beneficial um, if you're trying to, in a short or medium term, like you're trying to reduce volatility. Of course, long term, if you just invest in S&P, you'll probably more likely definitely outperform this fund because this fund is more of a defensive type play. But anyway, so like for example, this fund, let me see the 15 one. Does this so now this one, it looks similar, but it's the same September, but check out, it's slightly different. So now this one is ticker DDFX, 15% buffer. So the 15% buffer means anything of course lower than And keep in mind, when it's dual directional inverse, right? So as long as the S&P does not go under 15%, you make money, which is great, up into 15%. So the inverse. Now, you only start losing money once the S&P drops lower than the 15%. So if the S&P was to drop 16%, then you would lose 1%. So the buffer, that buffer only takes in effect once you start like losing money, of course. So if the S&P went down 5%, you would actually be up 5%. If the S&P went up 15, up like the 15, then you would down 15, you'd be actually up 15. Now if it goes past the 15, that's when you would start losing money. Now you'd be like, okay, wait, what about this one, the outcome period cap? Now the outcome period cap, this cap is when the S&P is positive. So if the S&P is positive 10%, the max you will only get is the 9.30%. That would be the max you would get, because the outcome period cap is based off of, that's what you would be looking at if the returns are positive. If the returns are negative, then for you to make money, you just look at the income, the inverse cap, the 15. So you'll make money as long as it's under your the loss is under 15%. Now if it's greater than 15%, that's when you'll start losing money. So if the S&P was down 20%, you would only be down 5%. Said everything that I would like to go over. If you have any questions, I'm hoping I explained it to the best of my ability. Oh yeah, let me go over, some of the pros and cons I end up, you know, uh, so summary. Um, the pros is you can make money whether the market goes up and down. You get the downside protection, easy to use, flexible. You can buy and sell at any time. And then it's an ETF. You don't have to watch the stock. Well, you don't have to really watch things, and you can just let things play out. The cons is it definitely has an upside. It has a complex structure inside. It does have a higher expense ratio. Returns, and this is more short, medium. So long term, you'll typically underperform given the fact that the S&P, generally speaking, has more up years than down years. But it does give you that peace of mind, downside protection. To me, it's could be pretty useful, especially if you need some stability in the short term versus just whatever happens to the market.